All right, and we'll let everybody kind of flow in here. If you are here for Tax Tuesday, first off, welcome. Welcome to another Tax Tuesday. This is apparently Tuesday.
Apparently it is. How many of these have we done, Toby? A lot, right?
It's been a lot of Tuesdays.
lot of Tuesdays.
And I am joined by none other than Scott Estel. If you've never met Scott Estel, Scott, I've known you for a while now.
Yeah, a few decades now. Hate to admit it, but it's true.
Decades.
Yeah, not centuries, decades.
You know Sherry?
There you go. I do.
Hey, Sherry. She's saying hi to you, Scott.
Yeah, no, she's not saying hi to you, Toby. I can see that from
Well,
it just says hi, Scott.
all right, so Scott Estel is a former IRS trial attorney who has been recovering ever since. And sometimes I do wear a tie, guy. Oh, it booted you out too. All right, so we brought Scott on just to
make everything crash, I guess.
Just to
the way it goes.
Make it suck for him. Here, let me share this out. There's that. All right. If you can't have a technical difficulty, then you're not trying hard enough.
That's right.
Q&A.
That's right.
I don't even see Q&A anywhere. Anyway, so guys, we just had a power surge or something knock us out for a second. So we are back. We are back. Oh, wait. Yes, it does. What happened? You are back. Sherry, we were just hiding from you for a second. So hopefully everybody's still out there. And it's very exciting. All right. So we're supposed to be talking about taxes. So one of the things that we do at Tax Tuesday is answer your questions. You can ask questions live in the Q&A. And actually, I'll go to the next slide because that'll actually give you the instructions. The Q&A feature is where you can get your questions answered by our staff, where we have a bunch of tax attorneys and accountants and EAs and other staff that are there to answer your questions. And I'm looking at it. We got Elliot, Kate, Lisa, Summer, Trisha, Jared, Dutch, Troy, Arash, Matthew, a whole bunch of folks that are there to answer your questions. And they love it when you ask them lots of questions. So go into the Q&A and answer it. I think we booted everybody, Matthew, because we're about half the participants as we usually are. So I think we nixed them there for a while. So hopefully everybody's back in. If you have comments, you just throw it into the chat. So it's actually really simple. You just, if you have something that's a quick qualifier, put it into chat. If you have a question that you need answered by a professional, you put it in the Q&A. And if you want to, if you have questions in the 2 weeks when we're not doing Tax Tuesday, send it in to Tax Tuesday at Anderson Advisors. We actually answer all those. And it's a lot of fun. So anyway, somebody's asking, can you go over amortization of a vehicle bought for cash? I'm going to say, Adriana, put that into the Q&A and somebody will go over you. Anyway, so we have a whole bunch of questions. Scott, we're not going to answer them yet, but I'm just going to go over the questions that we're going to answer today. So this will be fun. There's about 10 of them.
Okay.
And have you ever done a Tax Tuesday before?
I have not. So it'll be my first experience here, but let's see what kind of questions we have. So hopefully one of us can answer.
We'll go over this. And actually, I should give here. I'm going to go back here and just let you introduce yourself a little bit since not everybody knows who you are.
Yeah, absolutely. So Toby introduced me as a former senior trial attorney for the IRS. So I left actually 30 years ago. I hate to admit that, but back in 1994. So I'm a Chicago boy and worked for the IRS. I left as a senior trial attorney. And for the last 30 years or so, I've been representing taxpayers. So I'm pretty much retired now as far as.
We're back, not a crash, just a glitch. All right, I'll share my screen again.
Yeah, this is strange.
Yeah, we've never had it happen before.
That's what happens when you invite me on.
Yeah,
you get more technical difficulties than you know what to do with.
Yeah, well, I've never used the workplace. What is the workplace, Matthew?
It's just the Zoom updated to
Zoom
like
update
6.0 or something.
All right. Well, they suck. All right. We better answer these questions quick
before they knock us off.
Before they boot us again. All right.
Yeah.
So anyway, so Scott was just off 10 seconds. So Scott was a trial attorney and has been practicing in the area of controversy work ever since. And so if you have controversy questions, you've been audited, or you just want to know how it actually works, we will open it up for that, but you can throw it into chat at some point. And inadvertent, like in between the other questions we're answering, we might weave in some of those if you have some good questions. It's always fun. I am not going to touch any more stuff because every time I do, it seems to crash. All right, 1031 exchange. What are the other options besides investing in one single property, and how do I find them? So we'll answer that. Will you be able to say a word or two on reverse 1031s? We'll answer that. We are likely to buy before we sell and would like to figure out how to do a 1031 exchange in this case. So we'll get it. It looks like first two questions are going to be 1031 exchange questions.
All right.
So we'll dive into those in a second. As a 1099, what is the best way to leverage my LLC to save money on taxes? How can I save on self-employment taxes? That qualifies as taxes, and we'll answer that.
Sure does.
I have a C-Corp that allows reimbursements for medical expenses. Is there a limit to the scope of the type of medical expenses eligible for reimbursement? I plan to reimburse for monthly premiums plus out-of-pocket copays for annual procedures, checkup, etc. P.S. I love the YouTube video where Toby touches on how an HSA is great for immediate tax avoidance. It allows investment funds to grow tax-free. What a great summary that was. I like
Hey,
that.
way to go, Toby.
You
got
guys
you
should-
got a compliment.
You
out of
guys
that
should
one.
have more of those. I've
Yes.
decided. Let me see if I could actually get down to the. We're just doing our best to completely glitch out today.
Apparently.
So I thought I saw somebody jump in, but maybe they didn't. All right. So sorry guys. I don't know what to say other than hey, the host disabled participant screen sharing. So maybe somebody could allow me to share my screen. That would be cool. Yeah. Thanks, Wade. Something with the chat is killing me. So I'm not going to open up chat again because every time I touch it, it seems to kill the feed. And we're just going to go answer questions. So hopefully that'll be good enough. Let's see if we can do this because we had hundreds of people on, plus we're streaming on YouTube. And the last thing we want is to leave you guys without a cool presentation.
That's right.
So we will make it happen. Here we go. All right. So I think we were going over the C-Corp and reimbursements for medical expenses. Is there any limit to the scope or the type of medical expenses eligible for reimbursement? I plan to reimburse for monthly premiums plus out-of-pocket copays for annual procedures. Oh yeah, and they said nice things about me. I should just read that part
Just keep
over and
reading it
over
over.
again.
Yeah, absolutely.
Yes.
Make sure everybody hears it.
I've just set up my entity with you guys, but I've already been doing business. Will I be able to write off startup costs that predate the actual formation of my entity? We will answer that one too. Question: how do I pay myself from my LLC if it is taxed as a partnership? In other words, what tax forms do I fill out to show the IRS that my LLC paid me for my work? Question mark. Can you use credit card statements as proof of expenditures? We'll answer that. When calculating employer contribution to solo 401k, how does bonus depreciation affect the number? What if I do cost seg and wipe out most of my income? Can I make an employer contribution? Fantastic. Would I be able to donate a property to a nonprofit organization and get the tax right off the sale year if the property was purchased in the same year? So get the property, look at the tax write-off. Oh, I see what they're saying, write-off. What tax implications, inefficiencies do I need to keep in mind when doing a fix and flip? Talk about an open question.
Wow.
All right.
Yes.
I am going to speak directly because, guys, I'm having technical difficulties all over the place. I'm going to speak to Troy, my friend Troy Butler. If you're
Hello.
rolling around, hey, I cannot open up the chat or Q&A. So if you get good questions for Scott and there's opportune times or there's something we need clarifying, just jump in, my friend.
And do Buckaroo.
All right. I don't want to touch that chat because it seems to be the source of all ill. All right, guys. Hey, if you like glitches, here's YouTube. No, if you guys like this type of information, you want more, by all means, there's YouTube. And also we teach the tax and asset protection workshop just about every week. We have a live one coming up that is in person in Dallas. It's very inexpensive to go to, and it's a lot of fun to get together. That will be the 27th through the 29th. We need to get you out to some of these, Scott.
Yeah, absolutely.
But you can absolutely pop in. The virtual events are on Saturdays, and fully staffed with a whole bunch of folks to answer your questions, and also We do a great job. Clint teaches them. Brent Nagy's been teaching them, which is really cool because he's been a client forever. Different perspective. It's just fun. So if you want to learn about land trusts, LLCs, corporations, living trusts, Wyoming statutory trusts, land trusts, personal privacy trusts, personal residence privacy trust, the tax and asset protection workshop's a great place to start. You don't need to click on that. Let's just dive in.
All right.
All right. So we want to dump in and do 1031 exchanges. What are other options besides investing in one single property? And then we can answer, how do you find them?
Yeah, well, I think first of all, you'd have to say, what's a 1031 exchange?
What the heck is it?
What does that mean? Well, it's Section 1031 of the Internal Revenue Code, and it's a way for real estate investors to be able to sell their real estate investments and exchange into another one and push off or delay the capital gains. So it's basically just a way to defer taxes, and with proper planning, I mean, you can actually eliminate them with estate planning, but that's what the 1031 exchange is. And so what you're doing here is saying, I've got a property. I'm going to make, let's say I got $100,000 of profit. I don't want to pay the tax on it. So instead of selling that, I'm going to exchange it for another piece of real estate. And when I do that exchange and I comply with all of the requirements, and there's, as I'm sure you can state, Toby, there's a lot of them, right? As far as different time requirements and who can handle the money and do the transactions. But if you comply with that, then you have a lot of opportunities to postpone the capital gain. And so if you've got a property that's worth, let's say 200,000 and you want to sell it, and now you want to invest in other properties, you're allowed to go out and identify up to 3 properties that you want to replace it with, or as many as you can, as long as it doesn't exceed, I think it's 200%.
The ones you actually purchased.
Of the ones,
yeah, 200%.
So you see, you've got some of these limitations, but if I've got a $200,000 property that I'm going to sell, well, I can go out there and identify as many properties as I want, as long as it doesn't exceed that 400,000 of value. So there's different ways to go about this, but one of the things I like about the 1031s is it allows you to change the type of real estate that you're doing, that you're investing in. So I have a lot of clients that maybe are going through and they have multiple single family residences and they want to get into commercial, or get into a retail spot or get into farmland or vacant land or something. And as long as the properties are in the US, you're good to go.
Perfect. And I think you were actually 100% correct. It's 200%. Yeah, it's 200% value
Right.
of it.
Of the one
And
you're
then
selling.
as long as you acquire 100% of the value, then you have no capital gain or recapture. And absolutely. So what could you invest in? I think the calling of the question is really, you don't have to buy just one property. You can buy multiple properties like Scott's laying out, including farmland, just land, timber, land, multifamily, commercial, residential. The only restriction is that it has to be US or US territory if you're selling US property. If you're a US citizen, you're selling property abroad, then it's anywhere other than in a US territory, right? It's anywhere else. Like if I sell a property in France and I want to buy one in Spain, I could do that and still 1031 it for purposes of US taxation. I still have to deal with French taxation.
Right. The local tax you
Yeah.
always have to deal with. Yes.
But and then where do I find them? Anywhere. Like there's nothing special about the property. It's not designated 1031 exchange property. You're using a qualified intermediary to buy those properties. The less people that know that it's a 1031 exchange, the better. You don't want to advertise that it's a 1031 exchange, because what you'll have is a mean guy like Scott might say, "Hey, yeah, I'll sell that to you," and push your closing. Hey, you better pay me an extra 25 grand or we're not going to close on time, right?
Right. And you've got this 180-day rule that says you have to close on the new property within 180 days of the sale of the old property.
Yep.
Right. And those dates are absolute too. So you close on the 181st day,
you're toast.
Yep. You got to pay.
And there are people that play games with that if they find out you're in a 1031 exchange. So just make sure you're not dealing with one of those knuckleheads.
Yep.
And that you have some fallback.
Right.
Reverse exchange is actually the next question. And I would say on this question is, for the previous question, you may want to consider reverse exchange depending on your scenario, how liquid you are. Because a reverse exchange is just kind of the opposite. I'll let Scott go into it.
Well, yeah, I mean, the reverse exchange is the opposite in the sense that a typical 1031 exchange, you sell your property and then you have the time to go out and get the replacement property or properties plural. In a reverse situation, you're going out and you're buying the replacement property first,
Mhm.
right? And then you've got 180 days to sell your current property. So the situation, I mean, the scenario works basically the same way. It's just a question of which property are you buying first, or selling first? Are you selling your current property, in which case you have a 1031, or are you buying the replacement property, in which case you have a reverse 1031?
And just remember, in a reverse exchange, when I say you have to be liquid, you need to be able to come up with the funds to buy the replacement property without selling the first property. You need to work through a qualified intermediary who acquires the property and holds title for you.
Mhm.
And then you sell your property. And as long as you sell it and close within 180 days of closing on the first property, you're good. So you want to make sure you're coordinating both. So if you know you're going to sell and you're like, hey, I'm going to sell, I'd probably like, hey, if I'm probably pushing the date of my closing as far back as I can on the reverse, on the initial acquisition, so that I can give myself as much time to sell as humanly possible. So that if something does come up, if you do have inspection issues or you have your buyer fall out, that it doesn't take you beyond the 180 days.
Right. I mean, that's absolutely critical that you meet those time requirements. And I think on the 1031s, what I've seen is that the sooner you get your QI, your qualified intermediary in place, and the sooner you get tax counsel, the better here.
Yeah.
Okay, because you've got a lot of different options as far as which property you're going to buy or sell first, what order is it going to go in, who's going to keep the proceeds, who's going to make sure that the 45-day requirement on identification or the 180-day requirement on closing, who's going to make sure that those dates are met so that we have everything. And then also there's a lot of nuances that come into play. You have this issue of boot, BOOT, which can be mortgage boot or it's cash you receive back. So if you're, a lot of these exchanges, you're not necessarily going a $200,000 property for a 200,000, right? It's not going to be exact. And so you may have to throw in some extra cash to make the deal work. Or if you get cash out of the deal, then you'll pay tax on what they call the boot or the cash that you receive.
You sell a property that's
know.
got $100,000 loan on it. You buy another property of equal value and you take $150,000 loan. You walked away with $50,000 of boot that they're going to tax you. You can solve that by closing, waiting to do your refi. I think you get around it.
Yeah, there's always workarounds on a lot of this stuff, but you need to know about it in advance. And so I've seen people, list their property for sale, get a buyer, and then they're scrambling to find a QI. Because if you go close on that property and you take possession of the money at closing, which would normally happen, right, in a normal real estate deal, you have no 1031 exchange. Once you take the money, you're
done. Right.
You're
you
done.
Can't touch it. You can't touch it.
So this is all stuff that needs to be planned. It's not something that we can do and then retroactively undo stuff or manipulate some numbers and maybe get you into it. It's like either you do it or you don't.
You're like MC Hammer.
There you go.
Can't touch this.
Can't touch this.
So Scott keeps talking about a qualified intermediary. Where do you find them? You look at 1031 exchange companies. That's what they are. 9 times out of 10, 99 times out of 100.
Yeah.
They're a qualified intermediary.
Yep.
Qualified intermediary. There we go. QI. All right. Here's another one.
Real quick, we've had a question come up in the chat that I think might help the entire group.
Yes.
If during the identifying process you find 4 investment properties and identify those, do you have to buy all 4?
No. So go ahead, Scott.
No, you're right. I mean, your identification it basically identifies the properties that you can buy, but you don't have to buy them. I mean, if you don't buy any of the identification ones, then you just have a failed 1031 and you've got a taxable event. But if you identify, say, 3 or 4 properties or 10 or whatever the number is that you're allowed to identify, as long as you close on 1 or more of those and you don't take any cash out of the deal, you should be good to go.
Yeah, the rules are, I think it's up to 3. So if you're doing what's a traditional Starker exchange, which is when you sell and then buy, some people call them you could do a swap, kind of falls in that same category, though you almost never see a swap. You almost always see the starker exchange where you sell a property and then you're trying to buy one within
Yes.
180 days.
Yes.
That 45-day period is to identify a property or properties that you're going to use in the exchange to cover the relinquished property value. So you could go up to 3, and as long as you close on 1, and that value is going to be used against the disposed of property. So if you sell a property worth 500,000 and you identify 3 properties, each of which are worth 300,000, you'd need to close on 2 of them to avoid tax. If you closed on 1 of them, then you're going to pay tax on 2/5 of the profit.
Right.
Right.
Yeah, you'd have sort of a partial 1031 in that situation.
Because you bought 300,000 for, of replacement property against the $500,000 disposed of property. If you close on 2 of them, then you have $600,000 of replacement properties to cover $500,000 of disposed of property, and you're fine.
You
Right.
just have to put in the other 100K there,
Yep.
in that. But, the one thing I was talking about before was the 200% rule. And this was a situation that I had in California where I had a client that had rental property in the Bay Area that was worth about $2 million. And they wanted to 1031 it because they had over $1 million of cap gains. And so we looked at it, and they were going into a different place. They were going to South Carolina. And so we identified, it was 40 some properties that we identified because we had a $2 million property that we could go up to 4 million.
Right. It's 200% of
yeah.
the disposed of property. That's the amount of replacement properties you can identify. And by the way, it's just something you're doing with your qualified intermediary. They're filling that out.
Yep.
It's I forget if it actually has a form number.
It doesn't have an IRS form that I'm aware of, but what I recommend there is that you give them the identification, you give them two copies of it, and have them date stamp them both and give you one of them back. And then that way you've got proof that you satisfied the 45-day identification. The closing obviously is going to be easy because you're going to have the settlement statement, HUD ones, or whatever it is, the title statements, to be able to show that this closing was here, this one was here, and then it becomes a math problem.
So so they identified $4 million worth of property. As
Right.
long as they close on 2 million of the 4 million, it doesn't matter which properties. It could be half of them, it could be more than half. It does not matter the number, it matters the value.
Right. I mean, like this client ended up closing on, I think it was like 22 properties. So they did a 22 for 1 exchange because their $2 million in the Bay Area was worth 22 properties at whatever, 90,000 a piece or whatever they were, back then in South Carolina. So again, you have a lot of flexibility here, and it works really well if you want to have some sort of geographic diversification. Maybe I get out of California because that's where I live, or maybe I've got a lot of rental properties that are single family residences and I want to do commercial. So it allows you to stay in real estate, but change sort of the dynamics of what you're investing in, or give you a little bit of diversification in your portfolio.
Yep, 100%. All right, next one. As a 1099, that's a fancy way of saying an independent contractor. What is the best way to leverage my LLC to save money on taxes? How can I save on self-employment taxes?
Well, you start looking at this one, right? I mean, he's telling us in here, how can I save on self-employment taxes? He's telling us here that he's a sole proprietorship, that he's because your LLC, it's like that doesn't really tell us anything. Your LLC can be disregarded for taxes, which it sounds like it is in this case, and he'd file a Schedule C. But we could have an LLC and tax it as an S corp, tax it as a C corp, tax it as a partnership if we have at least 2 members in the LLC. So, there's lots of different ways to go about this. I mean, my first thought here is, well, let's just get rid of the self-employment taxes and make this an S corp.
That's what I would think.
Something where you can take distributions in lieu of the self-employment taxes, where you're paying that on 100% of the net profit, as long as you're taking a reasonable salary, right? And the reasonable salary then is going to pay the employment taxes, which the self-employment taxes and employment taxes are basically the same thing.
The only thing I would say, Scott, is we're assuming that there's profit, right? So
Yeah,
they're getting 1099. Let's just say that in this particular case, this person is they're getting 1099 for 20,000, but they have, $30,000 worth of expenses, so they're running at a slight loss. I probably wouldn't do anything.
Mm-hmm.
Flip that around. They're making $50,000 net profit after all their expenses. Then it's going to likely make a big difference for them tax-wise to make that S election. Under those circumstances, they could probably save a minimum of $4,500 to $5,000 just by making that one election and running a payroll once a year.
Yeah, I think so, because you look at a $50,000 profit, right, on a Schedule C, which is what this is, sort of a sole proprietorship LLC, right, a disregarded entity. You're paying a little bit over 15%, 15.3% on that 50 grand, right? So you've got a $7,500 bill immediately before you even get to the income tax component of it. And so what we're looking at here is, well, you got the 7,500. If I paid myself a reasonable salary, maybe I'd pay 3,000 or 4,000 in taxes for employment purposes, and I'll save the rest of the 7,500. So we're not talking about zeroing this out, but we're talking about reducing it. And this is also assuming, I think, that this person is deducting all of their expenses, right? That this LLC is claiming every single ordinary and reasonable and necessary tax deduction to begin with. And then we would look at ways to bring that down. Maybe do you have a retirement plan? Are you contributing to a 401 or a SEP or a simple or whatever it happens to be? And then once we get that down to the absolute lowest number, that's where the self-employment taxes come in. And obviously the higher your profit is, the higher the self-employment taxes, and the more likely converting to an S-Corp would make a whole lot of sense, in my opinion.
Yeah, absolutely.
Yeah.
And I would say, again, S or C, depending on
Mhm.
what you're doing. One of the things we like about S and C Corps is accountable plans, the ability to do the administrative office in the home, 100% deductions for things like your cell phone, your data. You're able to get a lot more money out. If it's a C Corp, you can do medical reimbursements. So like you're always kind of weighing these things. And I'll just say this, a lot of times you just get your pencil out, get with somebody who knows what they're doing and say, all right, here's my expenses. What's the best way to structure it? We use software on that. We do something called the Tax Saver Pro program, where we run returns through software, and it runs 1,500 different scenarios. Like it's crazy.
Sure.
And it's looking for what's the best way under these facts and circumstances, what would be the best outcome for you as a taxpayer. You're doing that type of stuff and you're trying to figure out what's the best outcome. That's all. That's the best thing you can do.
I agree with that. A lot of this is just a math problem, right? I mean, you've got, 100,000 coming in, you spend 40,000 of expenses, you got a $60,000 net, and we figure out what's the taxes with the self-employment and with the income. And then for me, not maybe using the software, I'll just have a piece of paper that'll say C and S, two different columns, and say, all right, what if this guy here made this same $60,000 profit and was in the C Corp or had an S Corp designation? What would be the ultimate taxes? Right. And a lot of times it answers itself. It's like, oh, you're going to pay 10,000 here, 8,000 here, and 6,000 here. And they're all legal, right? I mean, whichever way you do it, the IRS is going to process the return and there's no problem with it. So do you want to pay 10, 8, or 6? Right. And so we can make, some sort of.
Does the IRS make you pick the one that gets them the most money?
Right. They'd like to say yes, right? You have to pick the entity that's going to require you to pay the most amount of taxes.
It's up to you.
But it's up to you. You get to structure that. And notice the default here, right? You set up a single member LLC. The default is a Schedule C, which is the worst position you can have from a tax perspective. You're going to pay the most amount of taxes, and you're going to have an audit perspective of
IRS.
there you go, at least 10 times higher. So why subject yourself to an IRS audit, pay more tax when you have what I consider to be a pretty simple solution?
Preaching to the choir, man.
I know.
I'm always like, you're 1,000% more likely to be audited as that sole proprietor, and you get to pay more tax.
Well, you think about the IRS. If they have 100 auditors, how many of those auditors are trained to audit a 1040? And the answer is 100. Right now, they may not all be very good, but 100% of the auditors are trained on a 1040. When you go to an 1120 or an 1120S, what a C or an S Corp files, that 100 auditors may be down to 20. because you're now getting into a more complicated area that requires more education, more training. And so they just don't have the resources. And so, and a lot of people that are just starting out, they don't really know what they're doing. So they file a Schedule C and the IRS knows, hey, this is somebody that really doesn't know what they're doing.
Yep.
Or maybe is just beginning. So I'll bet we can catch them on not having a mileage log or not writing down what the business
Somebody
purpose
told
of a
them-
meal was. or
Somebody
whatever.
said, hey, there's less formalities if you do it this way. You don't have
Yeah.
to jump through all the hoops.
Don't have to hire a lawyer.
And you're like,
You know,
it doesn't work that way. The IRS doesn't care what you are. They're going to make you track your expenses,
that's right.
period. And you have to track them. They don't have to. They just say no.
Well, remember too, in an audit, who has the burden of proof, right? It's not the government,
Yeah.
it's us. And so it's
We
not
have
this,
to do it.
guilty beyond a reasonable doubt, and we can keep our mouth shut and they've got to produce all the evidence. It's like, nuh-uh. In this situation, you don't produce any of the evidence, IRS is going to disallow whatever they want, and you're going to owe a lot of additional tax. So there's none of this stuff where, oh, I don't have to give them any of the information. It's like, yeah, actually you do have to.
Hey guys, real quick out there, give me a thumbs up if you already have the tax toolbox. If you're a Anderson client, you've done the business there, we got a whole bunch. So
Okay.
there's a bunch. Yay. All right. So we just cut a big section on audits and collections and going through. So you'll like that. You get that absolutely free. We did tax-free income sources and we did
Did the IRS Dirty Dozen?
Oh,
So
we
we
did
were
the
looking
Dirty
at tax scams, but I think that's the thing, that you and I have talked about over the last year or whatever, is just having this ability to update the toolbox when new stuff comes out. Or maybe we get a couple questions. Toby may get, 5 questions on the same area. And it's like, all right,
gonna knock it out.
maybe we should do that as a topic, and so we'll keep adding to this as either the law changes or, some new topics come into play.
But one of the things that we did that for was because I wanted you to see before you ever get to tax court, how many chances you have to settle with somebody other than that initial auditor who sometimes is an nincompoop.
Yep.
Because 20 of them are trained to look at 1031s or 1120s or 1120Ss, and they may not know what they're doing. And we went through it painstaking, like we had boxes all over the place, but we mapped it out, the whole process from the dispute and the whole audit process to collections. And then I think it was 6 or 7 different ways we could handle collections. But it was a lot of fun. And the whole reason we did it, guys, is because knowledge is power when it comes to taxes, and also it alleviates fear. One of the things that you got to realize is right now the audit rate's in the toilet. I mean, it's you have about a 1 in 1,000 chance if you're one of our clients to get audited. It's really, really low.
Yeah, a lot of it is just total random, and they don't have the staff to be able to do it. But just to give you an example, my first audit that I handled after I left the government was a guy that had a whole lot of revenue on there, and it all came from an S corp. And I started looking at the S corp, and there was massive fraud in the S corp.
Uh-oh.
And so they're looking at the 1040, and they look at the Schedule E, and they look at the K1, and I gave them a copy of the K1. In a normal audit there, they would have said, okay, let's open the S corp, which at that point my client was done, right? There was like, I was going to have to get totally lucky, which I did because he said, what's an S corp? And it was like, oh, thank you. Thank you so much. Because guess who gets to educate him on what an S corp is, right? And so I educated him, showed the K1. Obviously, the number on line 1 of the K1 matched
Did he
the
pay
Schedule E. Oh yeah, everything cleared perfectly. And
no, did the auditor pay you? Like,
oh
hey,
yeah, auditor paid me for
you just took him
education.
to school,
Yeah.
right?
I thought you meant did my client pay me. It's like, you
Your-
bet my client paid me.
your
He was
client,
thrilled.
He better not have been there.
No, because we had a 3-year fraud case that would have been horrific that we ended up with owing like $1,000 on. And I've never seen a person more happy to write a check to the IRS than that guy was.
Thanks, Scott, for
Yes.
screwing us all.
There you go. So you're all paying more taxes because of
we
that
could have had some better roads,
one
except for
audit
Scott.
that I handled.
No,
Yes.
but it's the case in point though. It's like,
But yeah, you just don't know what the IRS knows, who's auditing you. We make these assumptions that these are, these are real jerks that are going to come in. It's like most of the auditors that I worked with are just good people.
So,
It just happens to be their job.
so just to be annoying. So
There you
you're
go.
walking in to see your client after you've had this meeting, and he says, you say like, here's the check you write. And he's like, I had to get that out.
You got it.
Had to get that out.
You got
Gave
it.
me chills. All right,
All
let's
right.
keep going. We've
Yeah.
gotten through like one question.
Let's go through the C-Corp here.
All right, I have a C-Corp that allows reimbursement for medical expenses. Is there any limit to the scope of the type of medical expenses eligible for reimbursement? I plan to reimburse for monthly premiums plus out-of-pocket copays
Good.
for annual procedures, checkup, etc. Then
What are you going to read the PS again, since it says how much they love your
I
YouTube
don't know.
video?
I just think I'll just leave it up.
Okay, we'll just leave it up there, but let's look at the medical expenses. So he's got a C-Corp, which is what you need for this, what's called a Section 105 medical reimbursement plan, right? Or health savings account, however you want, whatever. We're looking at the medical reimbursement plan though. And basically, yes, you are limited to whatever medical expenses are listed in the IRS publication. Do you remember what that is?
The cure prevent. Oh, it's 502.
502.
Yeah.
So there's publication 502 that has all these medical expenses out there, and they're what you would think they would be, as far as anything to diagnose or treat or cure some sort of a medical diagnosis here. And, really it's, there's not a whole lot of limitations on it.
It's medical, dental, vision. It's anything that's the cure, prevention, mitigation of disease or overall health. It does have to be legal. So you can't go get a prescription for weed and write it off. All you potheads out there, I'm looking at you.
That's right. You can't do it.
Can't write off the weed.
Not yet, anyways.
Yeah.
Not yet. We'll see what happens in the future. There's other things too, in play. Oh, woohoo.
Yeah, I can write off the weed. That's all they heard.
Yep.
You can't write off the weed. You cannot.
But there's a lot of stuff. Cosmetic surgery you can't write off typically as a medical expense, and there's a bunch of things you can't do. But for the most part, I think when you look at that publication, it's like it's page after page of things you can write off.
Yeah.
And if it's in there, your 105 plan and your C-Corp can certainly cover it.
Yep. It's quite literally it's extensive. The one thing I would say here, because they're talking about reimbursing their monthly premiums, is it can't be a previously reimbursed premium. So if you have a employer plan where they're paying for your premiums for your health insurance, you can't go in and double dip. That's all.
Yeah.
If it comes out of your pocket though, you can get it. And just to reiterate, Sherry can't write off the weed.
You have to single her out. I forget what Sherry lives, I think, in the.
Don't say.
I won't say what state it is because I don't want the DEA coming in there. But yes, you can't write it off.
We don't know what Sherry it is. Just kidding.
There you go.
I don't even know what weed is.
We're good. We're good there.
It's legal out here. All I know is that you can smell it all over the
But that's the
strip.
thing. It's legal in Nevada. It's legal in Colorado, but that's still even for medical purposes, right? So
Federally, it's
but
still
federally
illegal.
it's illegal, and until they change it, I mean, they want to move it from Schedule 1 to Schedule 3 as a drug, and once they do that, it's going to open up that as a deduction. But until that happens, and until it's formalized, in writing and statutory and whatever,
I think there's guys that try to write it off through a nonprofit. I think they have a church of weed or something like
there
that.
might be in California because of
It's Colorado. It's your backyard.
Yeah, the dispensaries in Colorado are for profit, though. The ones in California are not.
Not the dispensary, but they created a church.
Oh, a church. Yeah, maybe.
Yeah, because then they have to have it in their church. And they're
Yeah.
like,
Next tax Tuesday that I do, I will report back on that church that's in Colorado.
You
Let
go,
you know what it's
you
like.
go check it out.
I will check it out as a research project. So there you go.
Come back here with little slits of eyes. I'll know that.
But I'll at
something
least know
that's-
at least I'll know what's going on then,
You
right?
start forgetting my name. Man,
That could happen anyways, just on my age. But anyways, hey, what does this one look like? This is a startup.
Just
huh?
set up my entity with you guys. I think they're talking about Anderson.
Yeah.
But have already been doing business. Will I be able to write off startup costs that predate the actual formation of my entity?
Well,
that sounds like a startup cost question.
Yeah. So what do they do with startup costs? I mean, overall, you've got this $5,000 limit on your startup costs and your education costs and whatever on that. But
Yes.
you've got all these other expenses. I mean, you may be paying rent, you may be paying wages, salaries to people before, you actually open up your business, right? To get it started. And, I don't know how you look at that, but, pretty much if it's a deductible expense, if you were already in business as a startup expense, I'm pretty comfortable taking it as a startup.
Yeah. So
Yeah.
you have startup and organizational expenses,
Mhm.
both at 5,000.
Mhm.
There's a phase out if it goes over 50 grand, I believe.
Yep.
Otherwise, you're writing it off over 15 years. So you could do your first five, and then if you have $10,000 worth of startup expense, for example, you'd write off five in the first year and five you'd amortize over the 15 years,
Mhm.
which is pretty brutal, right?
Well, that 15-year range, yeah. I mean, unless you shut the business down before that, you're going to have to wait out the whole period. But
You don't lose it though. I guess that's the
yeah,
punchline is
yes.
you don't lose it. So
Yeah, it's a timing issue more
Yeah.
than anything else. And, if you do have a lot of startup expenses, like Toby said, you just amortize them over 15 years.
And I'm going to say this, most accountants are going to say we can go back a year. There's no actual rule on it. So conservatively, most people are like, oh, we'll go back for 1 year and we'll grab those as startup expenses. If you could show that you were on your trajectory to open your business and that you were intending to make a profit from day one, then I would say you can go back as far as you want. There's cases where they go back many years,
Yeah.
but
I mean, those are typical facts and circumstances cases, right? That,
Mhm.
that Toby could go back 2 years, I could go back 2 years, and the court would, or the IRS would allow his, but disallow mine. You say, well, wait, they're both 2 years. Well, you have to look at the specific facts. This is what Toby was doing. He was on this
Mhm.
path where maybe I was like, I started it, then I gave up for a while, then I
or
did
you're dinking
this, or I
around,
just
you're losing money.
right. I'm not serious about my profit motive,
Yep.
really, is
And that's what it comes
boils
down
down
to.
to. Yeah.
The easy rule of thumb is if you could have deducted it had you been in business, you can deduct it when you do start your business if you go back.
Mm-hmm.
So it's just how you were operating.
Mm-hmm.
All right. How do I pay myself for my LLC if it's taxed as a partnership? In other words, what tax forms do I fill out to show the IRS that my LLC paid me for my work?
That's a good question. And again, here it kind of gets back to what I was saying before with the LLC, right? That's a weird animal in the sense of we don't know how it's going to be taxed, that you've got to make that election. So in this case, for whatever reason, we have partnership taxation.
Mhm.
And now we have one of the partners that is receiving some sort of compensation going along. And so in a partnership, we wouldn't issue a W-2 to the person, but we'd have what's called a guaranteed payment.
Mhm.
And I think that's the way a lot of, I'll use it as a guaranteed payment. You can use the line one of the K1, right? I think that's for the ordinary income component.
Mhm.
I'm trying to think of what else.
Would you be allocating the guaranteed payment on the form? Because it's not the
Mhm.
profit then.
Right.
There's an additional amount. So you're not having
Right.
to 1099 them. You're going to get it all to them on the K1.
On the K1, that's right.
Yeah. So,
That's right.
what's the form? It's the K1, not the 1099.
Mhm.
The reality though is that you should have an agreement for the guaranteed payment and it can't be related to the percentage or to profit. So in other words, I can't say, hey, pay me 10% of profit and that's a guaranteed payment. That is not a guaranteed payment. That is just an allocation of profit to you.
Mhm.
And it's non-deductible to the partnership. A guaranteed payment has nothing to do with the profitability of the company. So it needs to be a set amount.
Yeah, I look at the guaranteed payment as compensation for
Yeah,
services and not as a return on my investment. Okay.
exactly.
And I think that's really the way you have to look at it as, your K1 is going to show you both. It's going to
Mhm.
show you your guaranteed payment for working for the partnership. And then it's also going to show you your portion of the actual profits as well. And
Mhm.
obviously both of those numbers go on your personal tax return then.
Yeah, the K1's just, so you do a partnership file is what's called a 1065 partnership return, and it gives K1s to all the partners for their share of the profits or losses or other income. And
Mhm.
so when this particular client's going to get their K1, it's going to have guaranteed payment on it for any work that they did, plus it's going to have their allocation of the profit or loss. And they would attach that to page 2 of their Schedule E of their 1040.
And it all just comes out in the wash on the 1040 then.
Yep. Yay.
All right.
Can you use credit card statements as proof of expenditures?
Well, again, when we look at the proof, right? Remember in an audit, we have the proof. We have the burden of proof. So if I claim $5,000 of office supplies, I've got to, if the IRS wants to know, I've got to show them where that 5,000 went, right? This went to Office Depot, this went here, whatever. And the IRS wants a piece of paper to see that. So the question here is, if I get my Amex statement, right, and it shows Office Depot, $100, is the IRS going to allow that? Or are they going to want to see
They're going to want to know what
more,
that's,
more
yeah.
additional
They're-
documents?
They're going
right?
to say, what was that for?
Right.
And how was that item used?
Right. And you can, one of the reasons why I like having a dedicated business credit card here, where I can say to the IRS, here's my MasterCard. It's only used for business. It is never, okay, not once in a while, but it's never used for personal. So if I go to an office supply store and buy stuff for my kids for school, I put it on this credit card. If I buy it for my business, it goes on my business credit card. And a lot of times the IRS will accept that and go. But be prepared, though, that the credit card statement itself is not going to be sufficient. So you want to have the backup. Where's the receipt? Where's the statement that shows the 10 reams of paper that you bought, or whatever it happens
And I'll
to
say
be.
this, what about for like, a lot of folks may not realize that for, I think it's lodging and meals, $75 and below, you don't have to have a receipt for it.
Right.
So I don't think this would necessarily qualify as a receipt. It would definitely prove the amount,
Mm-hmm.
but you'd still have to say the who, what, where, and why, right?
Right.
I'd
Right.
still have to be able to say, hey, I met with Scott. We discussed business. Where'd we go?
Well, yeah,
You know,
that would be on this, right. So the restaurant would be on there, and the date
Mhm.
and the amount, right? But
Yeah.
it doesn't say, Toby and
Why
I
we
go
met,
out. Did
yeah.
we go out to after we played around the
Or
golf?
that we actually went out. It doesn't say
Yeah.
Scott and I.
That's right. It doesn't. It
It needs
doesn't.
to,
Maybe I went out with my wife, and that's a personal meal.
and that's
right?
where you get
So,
your phone and
right.
keep your calendar so that you can create this.
Got to document it.
If you're running fast and you don't want to like sit here and go through it all, I get that. But if you get audited, you're going to have to go back and say, all right, what were these expenses for? If they ask for that. Have you seen
Mhm.
them really dig into that?
If it's something kind of silly like office supplies or whatever, no, I haven't. Unless it's a really absurd number, really high relative to the growth
I've never
receipts.
seen them dive in
But
that.
they don't get into a lot of those expenses. They do like the meals and what used to be entertainment, the M&E. We don't have entertainment anymore, but the meals and travel, things like automobile, things that either you may not have the documentation, or there's a personal component in it. Like when I paid for this airfare to come here, was I coming here to go play in Las Vegas, or was I coming here to work? Right. And so obviously, if I don't write it down as in my day planner, I'm coming here to record for the toolkit, or I'm coming here for Tax Tuesday, or whatever it happens to be.
Tax Tuesday.
I've got to write it down though, right? Because, let's say the IRS wants to challenge my expenses from this trip. Well, this trip is going to get reported somewhere in 2025, right? When I file that return, and somewhere within 3 years from that, so maybe in 2027, I get audited, and they're going to ask me about a Las Vegas trip that I had today. You know what? And I barely have a memory of what I did yesterday, right? Let alone 3 years ago or something. So if I don't write this stuff down, I'm not gonna really remember.
At least it's not just me.
No, it's not just you. And I think there's probably a lot of other folks on the
Write it down.
write it down.
Get used to just,
Right.
again, use your little phone. Just get used to putting notes into your meetings and jotting down your expenses so that you know.
Well, yeah, I mean, and think about it. If I write it on the receipt, or I put it in a day planner or whatever, that, I had lunch with Toby today to discuss business, and everything matches up. What is the auditor going to do? And you're going to say, what? I mean, they're going to give that to you, which they will.
Do you have a recording of the conversation?
Right, or like, I don't think you met with Toby, or I don't think that was business. It's like, well, how would you know?
You don't have to prove that.
Right.
So usually what happens if you're going to have an issue at all, it's because you're extremely far outside the norm. So there was a doctor that had, I think he wrote off meals every single day. And the IRS came through and nailed him on I forget the name of the case. They nailed him because it was not very expensive. And they said it's not more than if you just personally had lunch. He was going to like a chamber every day. It was some sort of St. Louis Chamber of Commerce or something. And he was buying lunch every day And they just said it wasn't more than you would have expended personally,
Mm-hmm.
and they got him on it. But
Mm-hmm.
it was the thing that raised the flag was just that there was literally a lot of meals for the type of business it was and what was going on. So,
Sure, you got to look at the totality of the business. And if you
Yep.
got somebody that's in sales, they may have a
Yep.
couple meals every day that they're writing off. Other ones, maybe once a month.
Yep.
You just have to look, see where you're going.
all right, if you guys like this type of information, again, join us for the tax and asset protection event. Clint does a great job speaking. Brent Nagy, I'm on sometimes. Amanda is on quite often. And if you want to learn about LLCs, corporations, living trusts, land trusts, personal privacy, residence trusts, all those fun things, Wyoming statutory trusts, we go over it and we show you guys how to structure real estate investing for sure. All right, another one. When calculating employer contributions to solo 401ks, how does bonus depreciation affect the number? What if I do cost seg and wipe out most of my income? Can I make an employer contribution?
Okay, so we have a solo 401k, right? So
Mhm.
we have a one-person company,
Yep.
right, on here. And so you have to look at, how is the compensation being figured for purposes of the 401k? And then we also have an employer component and an
Yeah.
employee component too.
This is kind of weird because a cost seg implies real estate, but
Mhm.
a solo 401k implies an active business.
Right. So I'm not sure how those two work
Maybe
together,
it's
but
an Airbnb, maybe it's a flipping business. I don't know.
yeah,
Actually, it wouldn't be a flipping business if they're doing a cost seg.
right. They wouldn't be getting,
Airbnb or something like that.
it would
be
almost
doing it.
have to be something like that
Yeah.
where you're going to do it. But you have to look at the type of business, and a lot of times, especially if you have a solo 401k in a sole proprietorship, you have to look at what's the net profit of the business to be able to calculate how much you can put into a 401k. So if you're using cost segregation, which is a type of depreciation, or this bonus depreciation, which in years past has been 100% or 80% or whatever the number, think about that whatever you're taking there is reducing your net profit, which is the goal of it, but it's also reducing the amount that you can contribute to the solo 401k.
Yep. And the 401k, the easiest way to think about this is, there's two sides. There's the employee contribution, which is like $23,000 this year. There's a makeup provision that could get you to closer to 30. That's not what they're talking about here. They're talking about the employer portion, and the employer portion is the employer could contribute up to whatever you got as wages, period. So if they paid you $40,000 in wages, I could put $40,000 into your 401k. But they're limited to deducting 25% of that amount of whatever you received as wages. So again, if you receive $40,000 as wages, I could put $40,000 into your 401k, but the company can only write off $10,000. What does that do? What does it have to do with the profitability of the company? Zero, nothing.
Right.
You could,
right.
yeah,
Right.
you could still contribute. What it matters is that I paid Scott or the employee, then I can make contributions and deduct it, even if it creates a loss. Fun stuff.
Absolutely.
All right. Would I be able to donate a property to a nonprofit organization and get the tax write-off the sale year if the property was purchased the same year?
All right. So I'm going to buy something today and I'm going to donate it in 1 month.
Yep.
Sounds like, right? I paid $10,000 for it and I donate it. What's my donation, right? What's my value? So you have to look at any donation. The calculation here is fair market value on the date of the donation. And so it would seem to me that whatever you paid for the item there would be the amount that you would donate, unless something happened in the time that you owned it to increase or decrease the value.
So it's going to be the basis of the property within a year. If you go over a year, then it's the fair market value or its basis, I believe.
If the basis is lower, right?
I want to say that it's going to be the lower of the two.
Yeah, I think it is. I'm not positive about that though.
Yeah, but the IRS isn't going to let you buy something and donate it at what you paid for it if it's not worth that anymore. So if I bought a piece of property for 50,000, but it's worth 20, and I was like, I bought it and then the market crashed, I'm only getting the fair market value. I'm going to get whatever's less.
Yeah.
So, but I think in most cases, I'm limited to my basis.
Most of the time. I mean, the only thing I can think of here is if you bought, say you bought a piece of artwork for, $10,000 and the artist died or something happened and that jacked the value up. I mean,
It's still over a
but you
year.
still got that year holding period,
Yeah,
right?
they say you have to, for appreciated assets held
Mhm.
under a year, it's the basis.
Right. Right.
Or the fair market value, whichever's less.
Right.
In the case of over a year, I think it's the basis or fair market value, whichever is, still think it's less, I think it's whichever one's higher.
Yeah, I think if it's over a year and the fair market value is higher, I think you
Yeah.
get it as long as you can show why the fair market value is higher,
Yeah,
you know?
you get the appraisal. You have to
Yes.
attach the, whatever that form is, 8823 or something.
Yeah, that it gets attached to the Schedule A on that. Yep.
I think I butchered it. I don't know what number the form is,
I
but
think it's an 8283, I
yeah,
think
you're right.
is the
8283.
form that you would put in for the appraisal
Yeah.
information. I think it's, what is it, $500 on some and some is 5,000, assuming it's not cash.
Yep.
But something where you're coming up with a value that you're taking as a deduction. If it's not cash or
Sizable, you're gonna get an appraisal.
you will.
Yep.
Yep, you better.
All right, including crypto, which is
Yes.
weird.
Yes.
Yeah, so you actually have to get appraisal on crypto. They'll do it for about $300.
Yeah, I bet they will.
It's weird. Oh, let me just look. Oh, this was the day. Yeah.
Yeah.
What tax implications, efficiencies do I need to keep in mind when doing a fix and flip?
Ooh, a fix and flip here, huh? So we've got somebody who is buying a piece of property, fixing it up and selling it in hopefully the shortest period of time possible, right?
Yeah.
So what kind of tax implications do I have on that? Well, if I'm doing this, as a business, this is my business to fix and flip, then I'm a dealer, what's called a real estate dealer, and I've got some pretty serious tax implications if I don't structure my business properly. So I think you have to look at the fix and flips is this a one-off? Right? I got 30 rentals and I'm going to do one fix and flip type of situation, or am I doing this as a career or as a job? And the more fix and flips you're doing, the more likely you're going to be a dealer, and the more likely it is that the IRS is going to want a lot more tax. They're going to want self-employment taxes on the sales, which you think, well, real estate sales, they don't have self-employment tax, and that's generally true. They don't. But if you're a dealer, you will get hit with that tax. So we need to look at, all right, if I'm going to be a real estate dealer, what am I going to do?
Right. So a dealer, you're treated as though you have inventory, so you don't have depreciation, you don't have installment sales, you don't have 1031 exchanges. The purchase of the property does not get to be depreciated, so it's literally just sitting there on the shelf. And whatever costs you put into it, so if you're fixing it up, all that's doing is increasing the basis of the asset, so that when you sell it, you pay less income on the gain.
Mhm.
And I say gain, but it's actually ordinary income. It's taxed whether you held it a year or not. It's going to be taxed as ordinary income at your normal tax bracket. So you're 0 to 37%, plus if you materially participated, which invariably you're going to have to if
Mhm.
you're fixing and flipping this,
Mhm.
then it's also employment taxes on it as well.
Yeah, it can get to be pretty ugly as far as that goes. When you're looking at potentially a 37% income tax rate, a 15% self-employment tax, and then you may have, if you live where I live, you got a 4.5% state tax as well. So, so you put all that together and you're into the mid to high 50% range if you are doing these flips and you have no tax plan.
So the tax plan would be for employment taxes is the S-Corp. For overall would be a C-Corp. And in either case, you could be an LLC tax as an S-Corp, LLC tax as a C-Corp. It's going to make a difference from your tax standpoint. The inefficiencies of fix and flips is stark. It is basically a car dealership. You're buying cars, putting them on your lot to sell them. You're buying properties, putting them on your lot to sell them.
Right.
Even though they didn't physically go to a parking lot, they're sitting in a lot as far as the IRS is concerned of your inventory, waiting to be sold. So you don't get to, there's really very few deductions until you toss that thing,
Right.
until
Yeah.
you sell it.
Yeah.
And
Once you sell it, then you can match the expenses and
Yep.
claim them all. But until you do that, yeah,
corporate
you're
entity,
very limited.
accountable plans, 401ks help, so you can defer it. There are some ways to offset income, everything from charitable deductions, oil and gas, real estate professional, active participation in real estate, short-term rental loophole. There's a whole bunch of different strategies you could use to reduce the tax. But I guess for this one, the big one is just understanding that fix and flip. I may as well be a pizza shop.
Mhm.
Oh, hold on.
Whoops, pizza shop.
Pizza time.
Yep.
Pizza,
It's a
pizza.
pizza. Yep. It's the pizza shop.
So yeah. I mean, you have to look at this as the real estate is not an investment. You're not an investor. The real estate is inventory, and that
Yeah.
changes everything.
If you're a
quite
dealer.
bit. If you're a dealer,
Yeah.
right? And actually, didn't we do an entire? We
We
did an entire presentation toolbox on
And the
real estate
toolbox.
dealers and real estate professionals, and I think we go into a lot more detail there as to, what's a dealer, and if you are a dealer, what are the remedies, right? How can you
Mhm.
fix it so that you don't end up paying 55% or some ungodly number in
So if you
tax?
have the toolbox, you really should go in there and explore it. There's a lot in there. I think we did 20 hours.
At least
At
there's
least.
40 some videos in there.
And
I
we just
think.
did 3 more hours.
Yeah, 3 more hours
Yes.
today on that. But I mean, these subject, I mean, it takes a while to get through it, right? I mean, it's not like we can say, well, if you're a dealer is XYZ and you need to be a C-Corp. Okay, there's a 2-minute presentation, we're done. I mean, no, there's a lot of nuances as to what that label really means. And it's not just dealer. I mean, there's real estate professional. We have a lot of real estate agents that say, oh, I'm a licensed real estate agent, so I'm a real estate professional for tax purposes. And it's like, not necessarily,
Mhm.
and so you have to look at all of these labels and how the IRS sort of, throws us all into these categories. And if we're going to be put into one of these categories, I'm making a lot of money doing fix and flips. Why would I want to change? It's like, there's nothing wrong with doing that, but you don't want to give half your profits away to the government.
Yep.
Right. And so I think that's what we have to look at is, how am I doing? What am I doing with my business? How can I structure it? And what sort of tax rules are in play that I can use for my benefit? And that it all comes down to education.
Yep.
Knowing what you can do, and maybe more importantly, what you can't do.
Educate yourself. Knowledge is power. It also reduces fear, so you're more aggressive. And
Mhm.
kind of dovetailing back to where we started, the audit rates are really low right now. There's discussions of 87,000 agents being hired. I think they managed to get 13,000 hired this year, and they're losing them just as quickly as they're bringing them in. I think we were at 79,000 agents. And
Mhm.
put this in perspective, it wasn't that long ago we were over 100,000 agents.
Mhm.
It's not that they're dying off; it's that they're retiring, and people aren't entering the profession. So we really are in a weird place as a country. Congress has given the budget for them to go out and hire, but there's nobody to hire.
Well, yeah, I suppose here's the deal. Do you want to work for the IRS? Go to irs.gov and you can probably get a job.
Scott did.
I did, and then let me just say it's, nothing wrong with it, but you can probably do better. And just think about an accountant that's coming out of college now and is going to go in and, the IRS is going to hire him, or a CPA firm is going to hire him.
Scott went
you
for
know?
the money. He went to the IRS
For the
thinking
money.
for the riches.
Uh-huh.
Yeah, I don't think
I was probably making a good 45 grand a year when I went to them too. Of course, it was back in the
big.
1800s, maybe.
You get that at
you know.
In-N-Out Burger now.
Yeah, that's right.
They're going to give you 21
Yeah.
bucks.
But there's a lot. I mean, so a lot of the auditors, you think, oh, these are all accountants. No, they may be a philosophy major that can't get a job, right? So you don't know who's going to be auditing you.
philosophy major.
I did. I did.
I would
Remember?
love to have an auditor who was a philosophy
Yep.
major.
Well,
As long as they weren't knuckle dragging and licking paste, I'd be excited. I'd be like, "This is awesome!" I'm
Yeah.
dealing with somebody, because a philosophy major might actually start thinking for a second. But
Well.
some of them are just like, "My job is to collect revenue."
right. I need to find some tax revenue here, and I'm
Yeah.
going to find it whether it's there or
No,
not.
you can't write that off. No, you can't write that off. I'm like, some of the quotes we have from the
Mhm.
accountants are just, it's
Mhm.
just mind numbing at
It
this
is.
point. Like I can't make fun, but actually I could, but
But
it
yes,
would
we're
be
not going
nice.
to.
We're not going to make fun of the IRS. We love them. They're necessary. I just said that out loud.
You did,
All right.
and it's being recorded.
It is.
So
Yeah.
it will be used against you at a
I
future
know.
point.
Maybe some point though, they'll be like, "You mean to the IRS?" So we look like I said I loved you.
That's right.
You guys can't be mad. I also said you eat paste. All right. Questions.
Good
If you
deal.
guys have questions in the meantime, first off, thank you, Scott, for
Of
coming. and
course,
hanging
yeah,
out.
it's fun. It's always fun.
He comes in to do a tax toolbox, and I'm like, "Hey, you should do a tax Tuesday with lots of glitches where it crashes 3 times.
Right, and I will never, ever be invited back again because I'm gonna be blamed
no
now
idea.
for all the
I
technical
touched
issues.
the
We
chat.
never had a problem until
It
I
didn't
was here.
break as soon as I figured out, like,
Yeah.
I'd used my
Uh-huh.
deductive reasoning.
There you go.
But if you have questions, send it in for Tax Tuesday, Anderson Advisors. We do answer those. We do respond. And we also take the questions that we answer from that. Elliot, I have to give him a, gosh darn it, I suck at applause. For
Yeah.
Elliot picking the questions, great job.
Oh,
And you could always go to Tax Tuesday, or go to Anderson Advisors and take a look at what we have there. And of course, there's the Tax and Asset Protection Workshop and YouTube you can always go to. So Scott, I have to give you a big,
thank you.
we should have Scott back. Oh, stop it. That is doing
Yeah,
it.
it's good. Thank you very much, though. Appreciate it.
Enough
Yes.
of that. Enough of that.
That's all right. One more time would be all right.
Yeah, no. All right. So you get a big old, all right. So anyway, everybody's thanking you. We have hundreds of people on.
It's all
every
good.
time.
Thank you for taking time out of your schedule, everybody, to listen to us. Hopefully you got some good education, some good information here that you can use to reduce your tax bill, right? I mean, that's ultimately our goal. Let's come up with a tax plan and let's execute it. Let's make it happen.
100%. So guys, we'll see you in a couple weeks.